Welcome to the FI Investors Podcast, helping you achieve financial independence through real estate investing, one episode at a time. We talk about personal finance, mindset, and real estate investing. Whether you're a rookie or looking to scale your portfolio, we're here to provide you with the tactics and actionable steps to achieve your goals. Here are your hosts, Diego Corzo and Ward Mahoney.
Welcome to the FI Investors Podcast. Today I have my co-host with me, Ward. Ward, how are you doing?
I'm doing well, man. Good to be back here, Diego. What are you up to? How are you doing?
Oh, good here in Austin, Texas today, of course, as we're doing this live. Later this week, I'm going to be going to Puerto Rico, so super excited about that.
Hell yeah.
Yes, I'm going to be doing some recordings in Spanish over there.
Nice.
So it's going to be really cool. I'm meeting up with some entrepreneurs, and they're going to have me on their podcast, so it's going to be good.
Sweet.
It's going to be good.
Can't wait to listen to them.
Yes. But today we have Coach Carson as the guest, sharing all about building financial freedom through the lens of knowing why you're doing what you're doing. He's the author of The Small and Mighty Real Estate Investor, a book that just came out through Bigger Pockets. And he and I we've been friends for a few years now. And I really like having the conversations more about like life with him, about why we're doing what we're doing with financial independence.
Yeah. Super cool guy. One thing I wish we went a little bit more was his experience at Clemson and playing football.
Yes.
But definitely an awesome story. We really go into how he grew his portfolio, how he does some student housing, and really how he scaled. So this is a really good episode, and I'm excited.
Yes, and how he's built a lot of his portfolio through the private lenders, right? And being able to, how sometimes they started lending him at like 10% and then going lower to like 6, 7, even 5% at times. But we talk about how he was able to pitch that to his investors, especially right now when rates are a little bit higher than they were a couple of years ago, and showing that it is still possible to start investing in real estate right now. So it's good. But then, as you mentioned, we do have to have him back so that he can talk about more on the perspective of being an entrepreneur and sports and real estate investing and all of that.
Hell yeah.
Yeah. So with that, guys, one thing that we would really appreciate is if you guys can leave us a rating and review on Spotify, on iTunes. We would really appreciate that because it does help the algorithm and we can reach out to more people this way. Also, if we have 2 free email courses right now live, if you guys go to keys2fi.com, you can check out the 6 different keys to achieve financial independence. And then a little bit more on goal setting, you can go to achievewealthyourway.com, and it will be all about helping you building the right habits, creating a vivid vision so that you can have financial freedom in the future. Cool. Let's get to it.
Let's do it.
What is up, Ward? How are you? Welcome to the FI Investors Podcast.
What's up, Diego? I'm doing well, man. Really excited to jump into it here today.
Yes, and you are back in Austin.
Yes,
so
sir.
I know you were dealing with some family stuff, but welcome back.
Thank you.
The 2 previous podcasts, of course, I did one-on-one, but I'm happy that you're here again as co-host. And today we have Chad, a.k.a. Coach Carson. How are you?
It is great to be here, guys. Thanks for having me.
Thanks for coming on.
Yes, for sure. Chad, we met, I guess it was in DC in FinCon, or maybe it was in one of the FinCon's events years ago. And by this time, I was already reading your blog. I heard about your story already. And because you spoke Spanish too, I was like, okay, he lives in Ecuador. And I just wanted to just come in and say hi. And you responded to me in Spanish too and everything. I was like, oh, this is great. And ever since then, we've been connected on Instagram, chatting here or there. And I'm really excited for the audience to learn a little bit about your story, but also the philosophy that you have on achieving financial freedom. and we'll hear all about your portfolio. We'll hear also, I'm going to ask you a couple of questions about your travels, because I know that is something that you walk the talk from that perspective. So welcome to the show. Welcome to the FI Investors podcast. And Chad, so let's start a little bit with what your portfolio looks like, and then we'll go back to see how you started.
Yeah, sure. So if you look today in 2023, I have a business partner. So the two of us are 50-50 partners. We've been investing together for 21 years. So that's
21 years.
21 years. Yeah. Still
Cool.
Going, still happy. We're still doing great together as partners. And we started as flipping houses, but today we have mainly rental properties. And you can sort of look at our portfolio in two different pieces. We have a large piece. We have 100 units total, but out of those, there's 33 properties. So we've got some multifamily properties, smaller multifamily, 14 unit, 10 unit, two units. So we have a collection of those that are mainly student rentals. So I'm in a college town, Clemson, South Carolina. And so a lot of those multi-unit properties, that kind of piece of our portfolio is on the bus line, closer to campus. We try to rent they're usually like studio and 1-bedroom apartments that are convenient to getting to campus. And we go for like the grad students and more affordable college student rentals. We're not trying to go for like the luxury stuff like those other people do that. But that's been a niche that I started because I've lived here for 21 years and I graduated from Clemson University. So my first house hack was living in a fourplex, and I started renting to international grad students, and they were amazing. I just loved meeting them. And the Chinese students next to us would have a big barbecue, and we'd eat all this Chinese food and some other. So it was just kind of developed a niche of having that kind of college student rental. But then I have another piece of the portfolio, my business partner and I do, that are just kind of your traditional single family house, families who stay in there long term. We've got a couple mobile homes. So it's sort of a tale of two portfolios within one. And they both have advantages and disadvantages. And but they're all kind of local here within, most of them are within a couple miles of Clemson University, and then have some spread out in the upstate of South Carolina.
Got it. And how do you and your business partner basically split the tasks, or what's each other's roles?
Yeah, it's evolved over time. When we first started, it was like neither one of us had any money. He had more money than I did. I had like $1,000. He actually had a job or a little bit online business at the time. But back in 2003, when online businesses were not that cool, they had the 2001 bust, from the .com stuff, and it's now his online business is doing very well now. It's in the sports world. But at the time, he was making enough money to pay the bills, and I lived in his spare bedroom at his house. And it was like he had his room with a bunch of boxes, and there's a bed under those boxes. And I was like, hey, I don't have any money. Can I sleep on that bed over there? And that's how we got started, is just flipping houses. And we used to divide the responsibilities up, where I was the deal finder. I was also the person who would go out and find money. So private money typically is what we would do to flip houses. And then he would manage the remodel, and he would manage getting it sold. And that's how we just, divided it up. And over time, it's evolved because we're more of a rental property business, and we both are pretty passive in the business now. But I am more the property, asset manager, kind of managing the managers. I'll get, if we have a maintenance issue or something, I'll get a text or a call about that. But even that, I tell people, and they don't believe me this, but the last 2 or 3 years, 5 years, really, it's been about 2 hours per week that I spend on our kind of maintenance, the management of the managers in the rental property business. So we've gotten it to a really good systematized, we have a good team of property managers, but we divide up we still talk about strategies. We buy a new property. If we sell a property, if we're doing bookkeeping and their taxes at the end of the year, we kind of split that 50-50, so it's just changed over time how we divide it up.
Yeah. And it sounds then that so question, as you've been investing, and of course you also have your personal brand, and you're the author of 2 books. What have you done? Because I bet you that you've had opportunities to say yes to other projects, other business partners, maybe other businesses. What has been that criteria that you say no to stuff or you say yes to stuff?
Yeah, it's a good question. Like my Coach Carson world is more, there's been a bunch of opportunities to, first of all, when you have a brand and audience, you could go raise money, like you could go do deals and syndications. And I've chosen not to do that, not because I'm opposed to it. It hasn't fit my lifestyle. It's really starting in 2000. 17 and 16. That's where I really felt like, okay, we're financially independent. I can travel. We lived in Ecuador for that period of time. I really just tried to, and even before then, prioritize having these seasons of life where you work really hard and you're like, you take time off, and you work really hard and you take time off. And I got this idea from what really resonated with me in the 4-Hour Work Week by Tim Ferriss way back in the day, this idea of mini retirements, and the idea that you kind of identify what your ideal lifestyle is. And then you, instead of waiting until someday, whether that's 20 years from now or 50 years from now, like, don't put off the life that you love, like the good life, until then. Like, why not intersperse that good life like throughout your life? And so my question for myself, that my business partner and I tried to figure out, and this led to the idea of the Small and Mighty Investor, was like, what real estate business model would actually, if we worked it backwards, would give us that large amount of free time, that large amount of flexibility. And so having that vision of like, well, a simpler business like actually would do really well. Like, we need enough money, but we've sort of taken the path where we haven't maximized our financial opportunities. We have plenty of money. Like, we're financially independent, doing well, but like, we could have made more money. But man, I have been like extremely wealthy in the amount of time I have and the flexibility I have. And I have young kids, and we've lived abroad for 17 months at a time and 12 months at a time. I got to study Spanish every day. I've written 2 books. So it's been sort of just figuring out priorities and saying no to the things, anything that would hamper my freedom, like kind of cut into my freedom and my flexibility. That gets the no. Like, that's the cool thing about financial independence. Like, if you have enough money, you have that place where you have enough, then every decision you make is not about money. It's about like, what's going to really resonate with me? Who are the people I really want to be around? What are the projects that really kind of resonate with my why, like who I am and what I want to accomplish? And so that's been kind of cool. It's almost like that time when you're a teenager and you're like, what am I going to do when I grow up? Like, what am I going to be? That's like when you become financially independent, it's the same question. It's like, all right, money's not the question anymore. Like, what do you want to be when money's no longer an issue? And it can actually be a little scary sometimes, like kind of identity crisis. Like, hey, no, I'm the person who works and does all this stuff. Like, well, maybe not. Maybe you could do some other things. Maybe you could expand your idea of what work is. And so I'm still in that exploration. I don't have that all figured out, but that's sort of the place I'm in.
Yeah. Yeah. Have you read the book Taking Stock by Doc G?
Yes. I'm big friends with Doc G, and I love his philosophy in that book as well. Yes,
the philosophy and like the deep conversations that have happened from reading that book, like doing the audits about life. And what you said is that identity, right? Because it's like there are times when you're in grind mode, or you're working and building and making the money, and sometimes you get to share wins on social media, let's say. And sometimes you get addicted to getting those likes of, hey, I got another deal done. Yeah. And then everybody's like, oh, you're awesome. And then you're like, hey, now I want to chillax, right? A little bit. Yeah. Throughout your journey, what's been those floors, right? Because I know, so I have your book here, The Small and Mighty Real Estate Investor. Awesome book. What's one of the things that you mentioned in that book is the different floors of income. And like you said, going to mini retirements. Can you walk us a little bit about how you've applied that in your journey?
Yeah. So just for people who haven't heard of that, the concept of it is an income floor. And if you think about like what the floor is in real life, like the floor is the thing you can push against that you can't fall through unless you're in a really bad house that has really rotten floors. But if you have solid floors financially, it's like this place that you build up to financially, where you sort of, I give another metaphor, like when you're playing poker, if you're playing poker and you've won a lot of money, you sort of take chips off the table every once in a while so that you don't lose all of it. Like the most risky poker bet is just to keep betting and keep betting and keep betting. A more conservative bet is like, take some off the table, then play with the house money, like play with the money you've already won. And so an income floor is kind of like that financially, is where instead of waiting for this big cash out someday, it's like you're changing the game you play. Like, instead of just maximizing growth, every once in a while you plow some money back and make a conservative move, make a move that increases your income, that decreases your risk, and gives you some peace of mind and some stability. And the cool thing is, like, for those of you who are like, if you're early in your financial independence journey, this could seem overwhelming to try to climb the financial mountain. It's like, crap, this could be like 15 years from now before I really get to realize this. But with the kind of the intermittent income floors, you can do it in little pieces at a time. For example, let's say you had a 5-house portfolio and you just decided like, all right, I'm just going to plow back some money and pay off 2 of those properties, or I'm going to pay off 1 property, because if I paid that property off, I have a $1,000 mortgage payment, and it's $100,000 loan because I've paid it down from 200 or something. And so you happen to save up 100,000 that you could spend on 4 properties to buy new properties that could build wealth and grow. And you'll probably get the highest return if you reinvested it in more properties and use leverage, right? We all know that. But if you plowed it back and paid off the debt on 1 property, you now have a free and clear house that produces $1,000 per month that is really low risk. Like having no debt on a property is very resilient. It can, if we have a great depression, if the rents go down, if you have a financial calamity where all that sorts of other stuff, bad stuff happen, you can kind of set that house aside and have this little income floor with $1,000 per month that's going to come in forever and forever. Just there's very few things that are going to mess that up. And then you can build upon that. So like for us in our journey, in 2009 was the middle of the Great Recession. And I'll try to summarize my Great Recession stories. That we made a lot of mistakes before the Great Recession. We bought a bunch of properties in 2006 and 7 that, I was in the go big mentality. That's kind of why I got into the small, mighty investor philosophy, because I was buying into like grow as fast as you can, buy as many properties as you can. And then 2007, 8, 9 hit with the Great Recession. It's like, all right, wait a minute. I took a lot of risk, and I was also super busy, and I wasn't doing the things I actually want to do, like traveling and playing basketball in the middle of the day. That's one of the things I like to do. If I just got married, so if I had kids, I wanted to be present with them. So like we kind of reoriented our whole business at that point to be simpler and try to not necessarily get as big as we could, but try to be big enough. And so that all came, like we started building the income floors from there. And even in 2009, we weren't financially independent, but we had like at least some solid income coming in so that we could survive. And then 2000, you move forward another 5-6 years, we built our income floor up a little bit more from there, to the point where now, like I feel like our income floor that I'm taking from our business now can cover all of our, normal kind of lean financial independence, like those bare necessities. It can cover like the normal, just normal living, and it can even cover like luxuries and, just cushion. So like when we were in Spain, if we wanted to take $10,000 per month from our real estate business, not a big deal, that we can do that and have a lot of resiliency. And so that's the beauty of like, almost like you're building brick by brick by brick as a real estate investor. The difference is like most time we just grow, and we have leverage. We don't ever like take some chips off the table. And my recommendation is not that you have to do it like right off the bat, but like if you're 5 to 7 years into your journey, 10 years into your journey, like start thinking about like, when are you going to start doing that? And when are you going to start like building your foundation for the long run?
Yeah. No, that really makes sense.
And Coach Carson, are there other ways that you can pull chips off the table within real estate investing, or is it just to pay off your primary lien?
No, and not just your primary residence, by the way. It could also, and I like paying off debt, but I still have some debt. So I don't feel like you have to be like, all or nothing. I like to encourage people to consider it because it's so sacrilegious to talk about paying off debt. But you can do things like having big cash reserves. Like that's what I did before I paid off a bunch of debt. Just like cushion so maybe you're pretty lean on your cash reserve. Like you only have a couple months of your operating expenses in the bank. Like that's pretty dangerous if things really got bad. Like in 2008 and 9, the only way we survived all the mistakes we made before was we had a big cash cushion. Like we had to dig into it. And so it's like insurance. Like you very rarely, hopefully never have to use insurance, but man, when you have to have it, it's like, that's what keeps you alive financially. And so I would say, first and foremost, cash reserves. Second, like start pruning your properties. Like, so I call it pruning, kind of like you're in a garden, right? If you have a fruit tree and you want to grow this beautiful apple tree, you actually have to prune back. You have to cut off some of the branches on the tree if you want the whole tree to be healthy and produce the most fruit. And I think your real estate portfolio is very similar. And what we've done for the last 10 years is we pruned off by selling off the properties that were the least optimal. Like they were in the wrong location. The property has high maintenance. It didn't attract the best tenants, whatever the reason might be. Like you make a list of your properties and you start pruning off, selling off some of the ones that are not ideal. And you can either do a 1031 exchange and not pay taxes on that to buy another property, or what we've done in some is just pay the tax. And then you can use that to accelerate your debt snowball or to your debt payoff on some other properties. And so it's just a mix there. But the point is that having cash reserves, pruning your properties, paying off some debt perhaps, and then just like working on your systems and your operations and just kind of cleaning and tidying things up. Because when you grow really fast, it's messy. Like it's just necessarily messy, and that's cool. But to have a mature portfolio that really serves you for financial independence, you got to have systems and checklists, and you got to have processes that can help you be more passive to get to that point where you're working 2 hours per week.
Yeah. Now, in your journey, you had talked a little bit about taking off those mini retirements, right? Tell us a little bit about how you decided when you were going to take that retirement, and like when, why, and what helped you work towards that.
Yeah, I'll tell my first one because that might be relevant for people who've never done one before. It was back to 2009. So if you remember my story, 2007 was when we overbought and we were like, all right, let's hang on by the skin of our teeth. Let's survive the recession. By early 2009, about a year later, we had sort of buttoned up the hatches. We knew the storm was coming. We felt like, all right, we're going to survive. This wasn't pretty, but we've got our properties. We're going to maintain them. We're okay. Like some of the mistakes we made, just if people are curious, are we bought properties in some locations that we wouldn't have, if we had to do it over again, where we kind of D+ locations. But not only that, like the next door neighbor was dealing drugs, or just was in a generally good location, but just the specifics of that location were tough, and we couldn't keep a good tenant. Or we underestimated repairs on a property, and instead of spending $20,000, we ended up spending $40,000 or $50,000. And where did that money come from? Our cash reserves, or any profits. So we didn't really make any profits for a year or so, but we got it stabilized. And so in 2009, I had started investing in 2003. I feel like naturally our brains work in like 3 to 7 year cycles, like life, like, all right, we push, we have this one thing we do, but like every 5 to 7 years, like either taking a break or doing something a little bit different or reconsidering what you're doing is sort of a natural thing. At least that's just my brain, but I think that's a good opportunity just to ask yourself, like, even if I'm not ready to leave my job or do something else, is there something I can do that's a little different to like detach myself from this pattern that I'm going on? And I look at it like you're growing by climbing a mountain. It's like, just, can I take a break? Can I take a little picnic and have a little plateau here just to think? That for me, that's traveling. And so in 2009, we went for 4 months. We got my wife and I didn't have kids at that point. We went to Spain. I took Spanish classes in Spain. It's a little too expensive in Spain. So then we were like, all right, we want to go to South America as well. We flew to Peru. That's where I spent a month in Peru. And that's where I really learned to speak Spanish and took classes every day for 4 hours. And we were in Arequipa, Peru, in southern Peru.
Yes.
And it's my still to this day, some of my favorite food and music in the world is from Peru. I love it. It's amazing.
That's awesome.
Got to see a bunch of sites there. And so we just had the point, I guess, is like that for us, travel is our thing. Other people might want to get an RV and go see national parks. Other people might want to start their backyard garden, but like just change the pattern a little bit. Like just look at a way to change it up, and you can go back to your pattern later. That's cool. But like, it's a gift you give yourself when you sort of take yourself out of the climb you've been in. And particularly for those of you who are like me, who are like A-type, go-getter, goal setters, like, especially you need to do it. This is like medicine the doctor ordered, because I had a moment in 2009. It was 6 weeks into the trip, and my wife, was a little bit easier to relax, and she's a Spanish teacher and, been in the kind of Latino culture a little bit, but I was the type A American who was like having a hard time, like letting go. And it was 6 weeks into the trip. We're finally sitting on this little beach, relaxing for a whole week, overlooking the bay. And I had a moment where I felt like a knot in my chest, like untie, it was just like, whew. It was amazing to like that tension that a lot of us have when you're climbing and you're growing. It's like an anxiety that sort of serves you while you're growing. So because you keep alert and you keep paying attention. But, I kind of wondered to myself, like, I was 27 years old and I had this knot in my chest that I physically felt untied. What had happened if I like went for another 10 to 15 years of like pushing that anxiety down? Like, well, what does that look like in your body and your health and your mental health and everything else? And so I guess that's why I encourage people, like, 5 to 7 years, those are good times to change something up. And these little mini retirements are just a good way to physically go do something different and get out of town for a little bit.
Yeah. Yeah. Was your spouse always there to be like, hey, I'm in the same page as you? Or what was that like with the relationship?
Yeah, like our first date, we talked about traveling to Latin America. Like very first date, we were like, hey, when she started talking, she had been to Guatemala, she had been to Mexico a lot, and I was like, I want to go. Yeah, that's what I want to do. Like, let's do this. And like my cheesy pickup line with my wife when I first met her was in a yoga class, and she told me she taught Spanish, and I was like, I want to learn Spanish. This is a good sign, right? And as corny as that was, it worked out. But so yeah, like travel and being kind of thinking outside the box has always been our connector. But the funny thing is, I'm more the capitalist, the entrepreneur. She was more like into outdoors and, just like minimalism and it's sort of anti-capitalism, like environmentalism. And so it's kind of funny how we connected on some of the specifics like travel and being frugal and just enjoying the simple things in life. But I came about it from a totally different direction than she did. Mm-hmm. And we sort of had interesting conversations about that. And I think we've both learned a lot from each other in that respect. But the common theme was, I think, she always wanted to travel. I did too. And so my kind of role was like, all right, let's figure out a way to have this rental income pay for it, and let's do this. And she would, then together we work on the trips and plan where we're going to go and kind of figure out how it's going to work.
All right. So Chad, on the book, The Small and Mighty Real Estate Investor, what are some things that people can take away, right? Because a lot of people think that you need 1,000 doors, you need 500 doors, even 100 doors at times to be able to achieve like true financial freedom. But what is the premise of the book here, and what can people apply?
Yeah, the main premise is to sort of flip the goal setting and the idea of real estate success on its head. So I know when I first started, the people I looked up to, and they were pretty impressive, were the people who bought the most properties, who owned the most properties, who did it the fastest. And there was something, there's something kind of like achievement oriented around that. They're like, oh, that's cool. Like they're going big. But the point I'm trying to make in the book is that like there's a lot of us who didn't start the real estate investing business to have the biggest real estate portfolio. Like we didn't, although it is kind of, you get that hit when you share on Instagram how many properties you have. That is cool for a moment, but we got into it not for that. We got into it for the freedom, like the free time, the flexibility to do all this stuff. And so the premise of the book is like, let's make a goal to have the minimum number of properties necessary to achieve our financial goals. Let's just figure that out. Like, what's the minimum number we need? And if you have really big financial goals, it might be more. If you have really simple financial goals, like I have a friend, Jillian Johnsrud in Montana. She has 2 properties. Her properties produce like $1,500 per month. And that's about a third of the income that their family needs. They have some other passive investments. It's business stuff. And but you know what? They go on like 6-month RV trips with their kids, like every single year. They live a good life. It's simple. And to me, people like Jillian are just as successful as someone who has 100 units, maybe more so, if they have the time and the freedom and the flexibility. So the point of the book is, that's the premise, is that let's have the least number of properties possible. That's what a small and mighty investor definition is. And let's grow at a pace that's reasonable. That's not necessary. It's like if you're going to run a race, if you're going to run a marathon, the people who sprint out at the beginning of the marathon, like they're sprinting, they're going to like collapse at mile 2 because this is a 26-mile race. And real estate investing and wealth building is the same way. It's like you need to pace yourself. Like the tortoise of real estate investing is still beating the hare like today. Like that's the old Aesop's fable. But like the steady, consistent way of investing is a super successful way of investing. And it also happens to be, we talked about all the mini retirements and the pace. It allows you to have the flexibility to not like box yourself into a certain pattern. Like when you grow, sometimes I talk about this in the book, sometimes when you grow, it becomes like, it takes on a life of its own. It's your business. It becomes like Frankenstein, like the horror story, like Frankenstein was a horror story where this creature came alive, and the scientists who made him like didn't intend for it to be this creature that killed people and did all this stuff. He thought it was going to be a great thing. And it turned into this awful horror story. And businesses can happen. That happens with real estate businesses and other businesses. We hear about the good stories. We hear about like the great stuff, Elon Musk and all that. We don't hear about all the like the crash and burns and the mental illness and the problems people have and the bankruptcies they have. I'm not saying it's not worth it. I'm just saying if there's another way to do it, the simpler and lower risk, and it gives you the same amount of freedom or more, like why not? Why not try that first? And that's the point. And so 5 properties, 2 properties, 10 properties. We can talk about the specifics of a portfolio if you want to, but it's very reasonable to live off a small number of properties, especially when we start talking about taking risk off the table. Like I mentioned earlier, like if you start paying off some debt, you start giving yourself some time, it's a smaller portfolio that generates a lot of cash flow. Like focusing on properties that generate a lot of cash flow can actually be just as good as a huge portfolio.
Yeah.
Yeah, and especially on your end too, as you got started, right? Before you got into buying a lot of those properties, like in 2006, 2007, you started with one house hack, right? I didn't know that you have a story of buying either a 4-plex or a 6-unit, right? Can you share a little bit on that one?
Yeah, my first 4-plex was it was a fixer upper property, had Merry Christmas spray painted across the front. And the reason I even looked at that property though is I bought a house, a single family house, and the house was, I couldn't afford it. Like I had another investor owner financed it to me, but the payment like was $800 a month or $850, and I was just an entrepreneur, had no money. Like how am I going to pay for this house? And so I rented that house out after like 6 months. I'm like, I got to be done. And I moved into the house hack, and that was sort of the evolution of my rental property business. Was just like, buy one rental, get it stabilized, in my case, live in it for a little while. And I still to this day think that's one of the best approaches to get into the business is just do a house hack, live there for a year or two, maybe you move up to another one, you keep the one you just had, you buy another one. Like if you just did that like 3 or 4 times, you'd have 3 or 4 fourplexes or duplexes or houses. And think about where you got just like 4 properties, and what could 4 properties do? And you could grow from there. And I did. I chose to grow, and I have a business partner. So if you think about like my 33 properties, like half of those are mine. So, 16, 17 properties, 50 units. So I'm kind of on the bigger side, but I have less cash flow with my 50 units than some people who live in higher price markets who have double the rent. Like my rent is $750 per month on average on my apartment units. So I actually have to have more units to equal the same amount of rent people get in other markets because I'm in a little bit lower price market. So it is the number you end up with depends on where you are, what your specific goals are, whether you have a business partner or not. But still, I think the aspiration of keeping it small as possible is still the way to go in my case.
Yeah. And how did you scale? Because you mentioned that you also have some apartment units. What was that trajectory of going from, like you mentioned, your first house hack to then now having those apartment units?
Yeah, so from a money standpoint, we mainly use private money so we didn't have W-2 jobs. Like we weren't very bankable. So we did get some commercial notes here and there, but to be honest, I was always really nervous and skeptical about using commercial paper, like borrowing money from banks, because I'd heard a lot of stories, just studying the history of real estate investing, hearing Dave Ramsey's story, for example. He had a whole portfolio of commercial debt, and the banks all called his loans due whenever things went bad. So there's always, like, if you look at a commercial note, it's like a stack of papers this big. And I promise you, this high-powered attorney that bank hired, they found at least 1 or 2 clauses to get you when they need to get you. Like I promise, always. And so a lot of commercial investors are finding that out right now because interest rates are adjusting. They're having to go back and refinance, and banks are not as friendly as they were on the front end. And so we use private money. Like we built a relationships with people who had like self-directed retirement accounts. These are just other real estate investors, and they had a retirement account that was $500,000 sitting in stocks, and they liked real estate. And so I showed them how they could loan me the money. And originally I paid them 10% interest. Over time, I started paying them 6% interest. And so we would buy properties mainly with private money, often with seller financing. Sometimes, every once in a while, was subject to, and some other kind of creative strategies like that, lease options. But most of them were from private lenders and we kept it pretty small, had like 5 or 6 private lenders, and we mixed in some bank loans with that here and there. And that was how we were able to scale it pretty well from what we started with.
Cool. And Coach Carson, so you also mentioned that you were the deal finder. How did you go about sourcing most of these deals that you ended up closing on?
Yeah, it's kind of like I could give you a list of them, but my favorite today is driving for dollars. And like my strategy is that it's almost like you're a farmer. Like, so you choose a farm market, and when you're new, the smaller, the better. So like, I would even say if somebody's in an urban area, like just pick a couple blocks. Like just those are my blocks. I'm going to farm those blocks. And for me, it was Clemson. I would just pick a zip code 29631, 29630 was the town next to it, and 29678 was the one. So I had like 3 zip codes that were my farm areas, and I would drive for dollars a lot. I would tell everybody else I knew in my whole world, hey, if you see a property like this, small multifamily, a fixer-upper house, whatever, like I actually sent out like a paper newsletter, believe it or not. Like people was kind of crazy. I sent a paper newsletter back in 2005 and 6 to like 200 people in my world, family members, my closing attorney, local mortgage brokers. And I would like have, news of the day, and here's a quote, here's some ideas. And it was just like, I guess I'm just a teacher and a writer at heart anyway, but it was just, I can't believe how much work I put into that. But every week, those 200 people, every month, those 200 people get my little real estate newsletter. But guess what the advertisement was? Hey, I'm buying properties. Like, let me know if you see this and this and this. And so I just had this like proactive campaign of building referrals from this little small farm, right? That's the key. Going back to the original part of the story, if you focus on the farm first, and I talked about that in the book as well, like how do you identify a kind of macro location, like the region of Austin, Texas, for example, but then importantly, how do you identify like a small little section within there that has a lot of promise, that has a lot of opportunities, and then you just farm it. You do everything you can, driving for dollars, networking, talking to real estate agents, sending direct mail. You could do like different types of direct mail lists, pre-foreclosures. I used to send letters out to everybody who evicted a tenant. They would always get a letter from me so that they, if they're evicting a tenant, they might be like, I'm sick of this property. Like if you get them right when they're just like in the throes of that, I would buy properties from that. I would send people letters on tax liens if they were behind on their taxes. I would get that's a public record. I would send a letter to them saying, hey, instead of having to come up with $5,000 to pay your taxes, why not just sell the property to me and I'll pay them when I buy the property? Things like that.
Cool. And so then now as you've transitioned with being able to buy the properties with other investors, right, using their money, what are your thoughts with everything going on right now with the interest rates, and what are you buying here in like 2023, 2024? Are you actively looking at deals? What's your thought process on that?
Yeah, like interest rates have changed the calculus. But the interesting thing is like it always changes, right? It's like if you again study history of markets, that's one of the most important lessons that I took away. Like talk to people who've been in the business for 50 years. Like I have John Schaub as one of my mentors. I have him on my podcast here and there just to hear from somebody who's been in this business for 5 decades. Like it's very helpful. And what you'll hear from them is that, like early 80s interest rates were 17% or 18%, whatever they were. And 6 or 7 or 8% is actually kind of in the normal range. That doesn't make it any easier, but people have been buying investment properties for decades and decades and decades. So how do we do that? Like the perspective, like what I'm doing, we just bought a single, we're still buying. We're very, very small buy box, very low numbers, but we bought a single family house that was right next door to another rental we have. And I talked to the owner for years. And when he was ready to sell it, he called me up. We used private money to buy that. Well, at some point we might pay it off with our own money as well. We paid, I think 5% interest to our private lender.
Wow. So, that's great.
And so this is a long-term private lender, kind of in-house, somebody who, just likes the security of what we're doing. And we give really low loan to values. That's another thing. So like, this is sort of a tangent, but I think it'll be helpful when you build private lender relationships. But this is just a debt relationship. I'm just borrowing money from them. They're lending it to me. It's not like equity partners, anything like that. But you got to offer them something, because if they're going to give you a lower interest rate, they might think to themselves, well, I could go like buy stocks and do like 7% or 8%, right? So why would they loan you money at 5% or 6%? Well, they might loan it to you because you put them in a very secure position. Like you never borrow more than 70% of the value of the property, maybe even less, maybe 60%, maybe even 50%. And think about how safe, if this person knows real estate investing, knowing they're loaning you 50 to 70% of the value of the property, I would always have this conversation with them. I would say, like, before you loan me this money, you need to know about the worst case scenario. Like the worst case is you have a mortgage on my property. In some states, that's called a deed of trust. And if I get run over by a bus, like, I hope you come to my funeral. I hope you shed a tear or two. But when you're done, I hope you're a little bit happy, because you're going to get this property back at a really good deal. Like we'll either deed it to you if we can't make the payments to you, or you'll go foreclose on us. Like, I don't like to talk about that, but like, you got to think about that and say, you shouldn't loan me this money unless you'd be happy to take the property back at that price. And that's the value to them. The value to them is they have a very secure investment that they understand the worst case scenario. Compare that to owning a stock, owning a crypto. Like, a lot of people don't know what the worst case scenario is. Whereas this is a very secure investment that gives them a steady interest rate. And so that's part of the answer today to buying properties with higher interest rates is you got to create your own opportunities. You've either got to get the deal, the property at a lower price, which is hard, like you have to hustle. You've got to talk to a lot of people to buy a property at 20% below value or 30%. So you need to look for situations where the property is distressed, or maybe the seller is distressed and they're willing to just sell it quickly to you. And so if you buy a property at 30% of below the full value, that gives you a better chance of making it cash flow, even at a higher interest rate. And if you combine that with finding debt or finding money at a lower interest rate, it's kind of like you buy price low. Well, you can also buy interest rates low. So can I go to instead of paying 8% interest, could I pay 5% interest or 6% interest to a private lender? And just like I talked about, show them how that could be beneficial to them. Or could I go to a seller? I used to buy a lot of properties with seller financing. And I think that's a huge opportunity in 2023 and 24 is either finding like retired landlords who own the property free and clear and talk to them about why they want to, if they want to sell the property, why do they want to sell it? What are they going to do with the money? Very often they just don't want to deal with the management of the property, but they like the income. They like to get that monthly steady income. And so if you can build a relationship with that seller, I've been able to buy a lot of properties where the seller financed it to me. And it's not unreasonable that the seller might finance it to you at a 4% interest rate or a 5% interest rate. And that might make the deal work. That might make the cash flow work instead of having to go to the bank and get an 8% loan.
Yeah. Yeah, and there's definitely opportunities because even here in Austin, for example, Ward and I, we bought a duplex. We bought a duplex last September, and it was on the MLS. He found the deal on the MLS. He came to me and we partnered up, but we were able to negotiate 7% down, 3% interest, amortized at 40 years. And a 10-year balloon payment. Like that was a freaking no-brainer, right? And but that was on the MLS, and there's there's a lot of people that say, oh, I can't find deals on the MLS. Number one is like seller financing and trying to find properties at a lower interest rate is not possible, but it is. You just have to talk to a lot more people.
Yeah, I think people have gotten a little bit lazy as investors. We've gotten kind of spoiled by easy markets. And I say, like, I'm not saying it was not competitive over the last 3 to 5 years, but the financing was easy. Like you just went to the bank, you put 20% down or 5%, whatever, and you got a low interest rate that made sense. Like that was easy. Let's just call it what it is. Like over the long-term history of real estate investing, it's always been hard to buy properties. Always. This isn't a new thing. So you got to hustle. You got to network. You got to talk to people. It's the hardest part of the business, which is why you got to focus on it the most. Like it's the most important lesson to learn is how to find deals, how to negotiate financing, how to negotiate all this stuff, because that's really the key that unlocks the whole deal. And once you own the property, there's some other challenges too, but like that's the hard part. That's the really hard part.
Yeah. Yeah. Now, one of the key questions that I want to ask you here is what are other types of questions or conversations that one should have when trying to find those people that can lend you money, right? Because you were able to, in the beginning, find people that can lend you 10 that had a retirement account. What are like the questions that we should be asking those people to see if they can become investors with us? Other than, of course, super safe deal, 50% loan and stuff.
Yeah. So I'll get to some questions in a second. I'm going to take a step back and say, like, where do you find those people? Because some people might be wondering that too. And where I found that is go to places where you have real estate investors meeting up. And so like the best places for me were like local real estate investment associations, real estate clubs. If you have like some towns that like you might find just through the network, there's a breakfast that a bunch of old timer real estate investors just have breakfast together. Right. So like step one is go fish where they're the long time investors are. You don't want to be hanging out with all the brand new investors. You want to go with like the people who have a bunch of money like that. That's who you want to hang out with. And so real estate clubs, real estate meetups, some of the old, every town has them, you got to kind of dig a little bit. Also, just like when you're in town and I used to go to foreclosure auctions, I would say, who's bidding at the auction? And sometimes not just bidding, who are the people just hanging out in the back, and like just chit chat with them, right? And you're just like you're going to build a list of referrals for anything else. Like build a list of people who might be potential candidates. That's step one. But step two is this is a slow kind of, you can call it a slow dance. This is not like I'm just going to go right away and find a private lender. To me, this is more of a build a relationship first. And for you as a borrower, you don't want to just borrow money from anybody, like, because a lender can screw you over. A lender can really put the nails to you. This has got to be a relationship of trust. It's almost like a partnership, but the relationship is very defined. They're the lender, you're the borrower, and you should know that like the lender needs you just as much or maybe more than you need them. Like there's a lot of money out there and very few deals. So if you're the deal finder, have that perspective. Like, I've got something of value here. Like, stand up straight. Like, you have a ton of value to offer to these people with money. And so here's how I would have a conversation with them. I would start talking to people. I think the best approach to meet new people is to be humble and to try to learn. And so these are people who have been in the business for a while. They're experienced. Ask questions. Like, how long have you been investing? Here's some rental properties I'm trying to buy right now. I would love, what do you think about that? Like, just ask questions, learn, let them be the teacher. And what you'll find is like the people, you'll start resonating with certain people more than others. And you build a kind of a teacher mentee relationship a little bit. So even if you're experienced, like, be the mentee, like, be humble enough to say you have something to learn. And then so that's step two, is just like meet them and try to talk to them. Step three is like, you're going to always plant seeds about what you're doing. Like, so, hey, I'm buying deals over here in this part of town. I'm buying here. And you can kind of tell when people are interested in that. And so at some point you got to ask the question, like, here's the like very short way of saying this. I would say, hey, I'm looking for money for these deals. Like, is this something that if I found a deal, you would be interested in putting up the money for me? Simple. Yes or no. So ultimately, this is sales 101. Like, you have to ask a yes or no question. Mm-hmm. You're asking the listening questions first, open-minded questions. Eventually, you got to ask, is this something you'd be willing to put the money up for? And notice I kept it really simple there. I didn't say, would you loan me the money at 70% loan to value, at 6% interest, and blah, 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 like all the specifics. It's just like conversational, simple. And if they say, no way, not interested, fine. They say, yeah, I might be interested. Talk to me a little bit more about that. And so they want to know more details. They want to understand it. And this is actually where my YouTube channel started, because I used to get these big pieces of paper and I was sitting with a private lender and I would just draw these little, like, here's a little stick man on this side, here's a little stick person on this side, and here's how the deal, you'd loan me the money, I'd give you the property. I'd draw these little circles and arrows, and it sort of like made it easier to understand for some of these people. And I started putting them on YouTube, and apparently that helped as well. People started watching it. But I guess that's a long way of saying, like, go where people are. Don't try to force it. This is a long kind of relationship kind of game. Step number two, just like meet people, listen to people, learn from people. Step number three, when you find the right candidates, they're on your list, don't be afraid to ask. Like, you have a ton to offer them. Say, hey, would you be willing to put the money up for a deal if I find the deal? And then if they say yes, then there's a bunch of details. How do you structure it? What's the paperwork look like? All that stuff. But there's a lot of work to be done before you ever get to that point.
Yeah. No, for sure. For sure. This is very helpful, because I know people here in the audience will definitely, my hope is that they take action on that, but here's the thing, like, you do have to go out there, put yourself in positions to have those conversations. And if you're lazy, it's not going to happen. You have to put yourself out there for sure. Now, Ward, what are the lightning round questions?
Sweet. So we'll jump right into it. So Coach Carson, basically what this is, it's a series of 5 questions, just rapid fire, one after the next. Are you ready?
Let's do it.
Awesome, man. What was your biggest hurdle with getting started in real estate, and how did you overcome it?
I think it was just seeing myself as not being an imposter. People have heard imposter syndrome. I was 22 years old, 23. I was like, who am I to be buying houses? I was living in my business partner's spare bedroom. Like, who am I to be buying their house? And so I don't know. I think we all have our self-doubt. And for me, I found a way to psych myself into it, talk myself into it, dress a little. I wear t-shirts all the time now. I'm not dressing up for anybody, but like back then I would dress up a little bit, try to make myself look a little more professional. But whatever you got to do to get your confidence up, that was what I had to do.
Cool. Do you have a personal habit that has played a major role to your success?
Yeah, just being organized, I think, is underrated. Like I used to play sports a lot, and some of my favorite coaches, like there's a guy named John Wooden, who was a UCLA Hall of Fame basketball coach. He used to plan like for a 2 hour practice. He would plan and prepare like for 2 or 3 hours, like 4 hours. Like, so I just think we underestimate how much preparation and being organized really helps. So if you're going to do a deal, there's a ton of preparation and detail work. And in real estate, it's a lot of details. There's a lot of paperwork. There's a lot of, I's the dot, T's the cross. And so I think that's like kind of the grunt work, like that's the dirty work of real estate investing. But if you get organized with your bookkeeping, with your paperwork, with your, it helps you in a lot of ways. Like with your private lenders, my private lenders were always really impressed how organized I was, and it gave them confidence that I could follow through. Yeah.
I love that. So what is one book that you've read recently that's had a big impact on your life?
Yeah, there's a lot. This is kind of a tangent, but because of being in real estate and also having more free time and financial freedom, I've gotten very involved in my community. And one of the things I've been trying to do, I was very frustrated by the lack of transportation infrastructure for walking and biking. And so I just started like learning more about that. I started a nonprofit with some friends to try to build a network of walking and biking trails. But along the way, I've been reading books just on urban planning, which I think for real estate investors is very interesting, because it's basically how towns are built and why they're designed and laid out the way they are. Why do we have zoning the way it is? And so there's a couple books it's actually a podcast as well called Strong Towns. And it's by Chuck Marohn, and I had him on my podcast as well. But he has a book called Strong Towns. He has another book called Transportation for a Strong Town, and I think both of those are really interesting. Just about the kind of pulling the veil back on how towns and cities function and how they don't function, and how actually a lot of suburban cities right now it's kind of a Ponzi scheme in terms of tax revenue. Like they raise tax revenue, but it's not enough to pay for all the infrastructure they have in a town. And so this is something important to know. Like some of the older towns in Michigan, for example, that ran out of money, that were bankrupt, they couldn't pay for their water infrastructure. This would be something important to know, to study your town and the design and how they're financed. But it's those books are pretty good.
Hell yeah. If you could go back, what advice would you give your 20-year-old self?
Have a heck of a lot of fun. This is a fun business. And if you're lucky, every stage is fun, but the grind, the hard parts, even those are fun. And I think some people might just think being an entrepreneur is a little bit crazy. Like the fact that anybody listening to this, like we're all wired a little bit differently. Like we have fun doing some risky, crazy stuff, some people like jumping off cliffs. I don't really like heights and doing that, but like starting a business, buying some real estate, getting into some debt, like, that's scary. Yes, there's some downside to that, but it's also fun. This is like, when you look back at the end of your life, you're going to say, I didn't go the boring route. Like I went the exciting route. Like I tried something, I did something big, I bought some properties. And so if you can just like have a glimpse of that in the moment, try to glimpse that feeling you're going to have when you're on your deathbed or you're older and you're looking back at this and you're saying, man, when I was 20, when I was 30, when I was 40, whatever the age was, I was really in the arena. I was doing this, and that was fun. If you can kind of get a glimpse of that, you'll have a lot more fun right now too. You'll enjoy the process.
Yeah, that's a cool perspective on everything.
That's a good one. And then last but not least, what does financial independence mean to you?
Yeah, financial independence it means doing what matters. That's the theme of my podcast, my website, is like the working it backwards from the activities in your life that really bring meaning to you, the people that bring meaning to you, and starting with that and making that the why, the center thing, and then build a real estate business around that why. Like that financial independence is really not even about money at all. It's really about living a good life. It's about being the best person you can be, and money at its best and real estate at its best is just a tool to help you do that.
Yeah, no, that is, I totally agree with you there. Do what matters. And so Chad, tell us a little bit about your website, about your podcast. How can people reach out to you? What they can do to learn from you?
Well, thank you guys for having me. First of all, this has been a ton of fun. Really love the show you're doing here. If people if they like listening to podcasts, I also post a podcast every week. It's called The Real Estate Investing with Coach Carson. It's very tactical. So sometimes I get into like, how do you, what are 5 ways to buy a property with little money? Another time it might be, how do you pay off debt faster? So a lot of the stuff we talked about today, I get into the tactics and also interview other people who are applying what we're learning here and who are at various stages of their real estate investing career. So it's all focused on being a small, mighty investor and how do you do that. And we'll love for people you can look up Coach Carson on any Spotify, Apple. If you look me up on YouTube, I have a lot of videos there. My podcast is in video form. And then also my website's coachcarson.com if you want to check me out there. And I have a email newsletter every week that you can, that's kind of where I update behind the scenes, what's going on with me, that type of thing.
Mm-hmm. And where can people buy your 2 books?
Yeah, so I think the book is called The Small and Mighty Real Estate Investor. It's published by Bigger Pockets. So you can get it on Bigger Pockets if you go to their website. That's where you'll get a lot of the bonuses. I wrote a bonus chapter called How to Be a Small and Mighty Investor in a Changing Economy. So a lot about the interest rates and how to apply this. But if you like Audible, if you like Amazon, it's also an Audible on Amazon right now as well. It's at Barnes & Noble. So if you just look for that book, also my other book, Retire Early with Real Estate, they're both out there. So just search for my name, Chad Carson, or The Small and Mighty Real Estate Investor, and really appreciate any of you who end up getting the book. I'd love to hear from you and hear about your success stories or things you learned from the book.
Yes. And I have to give you a shout out too. Thank you very much for having me on the back of the book here on the references too, because I know I told you a little bit about the story and we've always had great conversations. And hopefully in the future we get to share some great Peruvian food.
Yes, I would love that.
Conversations.
Yeah, I did want to thank you specifically, Diego. I just so everybody knows, when I was researching this book, I interviewed people behind the scenes who I respected, who were to me like kind of epitomized the small and mighty real estate investor. And I love your story. You've been on my podcast and really appreciate everything you bring as a teacher and as a role model. And so I interviewed you and got some stats on what your perspective was on all these different topics, and your feedback and a few others that I interviewed were kind of helped me shape the book and really helped me kind of guide it. So I want to thank you for that. And I did write about that in the acknowledgments as well.
No, yeah. So thank you very much for that. And I'm always down to help any way that I can and talk real estate, talk shop. So, and I look forward to seeing you sometime in the future, maybe at an event, real estate conference, or whenever you're in Austin too.
Yeah, can't wait to do it. Look forward to it. Thanks again for having me, guys.
Awesome chat.
Thanks, Coach Carson.
Take care.
Thank you for listening to the FI Investors Podcast. Make sure you subscribe so you don't miss any future episodes. And share this with a fellow real estate investor who you think would find value in what we do. Until next time.